Hello, Jim here. I've been a long-term income investor probably since the 80s. What I really like to find are good companies that pay good dividends, but also increase those dividends and have plenty of cash to pay for the dividends. Now, when you pair that with something like the option wheel, you can really do well. Today, I want to share with you two I found recently. One I've traded on before. The other one is kind of new to me. It's not a new company. Both of these are big, giant companies. And again, what I really like about them, they're good fits for the option wheel as well as for just selling covered calls. So between covered calls and dividends, you can earn around 10% a year and keep things really, really safe. So I'm going to go into detail on how I found these companies, why I chose them. I'm going to go into the numbers I like to look at. I'm going to talk a little bit about what I look at in Schwab as well as Seeking Alpha. So stay tuned. I think it's going to be well worth your while. Now, the first company I want to talk about is AbbVie. This is a company, I believe I've done 3 or 4 trades on them the last couple of years. I don't currently own any. I definitely want to own some. And you can see here by looking at their 5-year chart, they kind of steadily increase over time. It's a lot like a Coca-Cola. They don't shoot through the roof. They usually stay within a certain range. And they're fairly easy to sell covered calls on since they don't shoot through the roof. The PE is currently right around 15. Their earnings per share is 11. Now, if we look at their year over year earnings, they look fairly good. They do have a slight decrease in third quarter of 24, but then they have a pretty good uptick in both fourth quarter and the first quarter of 2025. So I like to look at this. You can see, and they've also only missed earnings slightly back in the fourth quarter of 23. The first quarter of 24, they did beat earnings by a small amount. So something I like to look at. Then I also like to, of course, look at dividends. I will show you in Schwab. I prefer to look at dividends in Schwab, but they do a fairly nice job here. So they give them, A and B rankings related to dividends. So the dividend yield is, nearly 4%, 3.64. And if you sell a put on it and you pick it up for a little cheaper, then that's probably going to be closer to a 3.7, maybe 3.8, which is a pretty good dividend rate. And again, I'm able to double the dividends. Usually for a company like this, I can even more than double the dividend. So I wouldn't be surprised, like I said, that if I can double the dividend, I could earn anywhere from 8, 9, 10% on a yearly basis just selling covered calls. And of course, earning the dividends. So between the premiums and the dividends, it would be pretty close to a 10% income on a yearly basis, which is really nice. Payout ratio's low. They're growing the dividend pretty well. So this tells me they have plenty of cash to cover it, and they've been growing the dividend for over 10 years, which is a good thing to look at. Now, I do like their profitability. Here you can see the sector median. The only area they have some issues is CapEx related to sales, but I really like to look at return on equity. They had nearly a 55, almost 56% return on common equity, return on total capital in the teens, which I really like to see. I like to see companies that are like 11, 12, 13, all the way up to 20, 30. The higher, the better for both of these. So really good profitability. I also like to come down here. I'll read the article, see what people have to say. I really like to look at the comments too, just to get a feel, for if anyone has issues or doesn't agree. Usually the people who write these articles aren't hardcore financial analysts, so you do have to kind of not really pick and choose, but just sometimes take it with a grain of salt. It may not be good advice sometimes what they're making, or the comments they're making or the way they make them, but overall it does give you kind of a feel for what's happening with the stock. And some do quite a nice job going into detail with analyzing, but a lot of them, again, it's kind of mixed. That's partially why I prefer reading the comments almost more so than anything. Now let's go over to Schwab, and I still prefer Schwab over Fidelity research wise. I like how they do it. They also talk about how it ranks with Morningstar. So Morningstar gives it 3 stars. It's got a pretty wide economic moat. So just a lot to like about them. And here you can see they've been increasing dividends. Schwab does a nice job here. And you can see they've been increasing them pretty substantially. 5-year growth, 10-year growth, you can see it's pretty substantial. And what's nice about that, so say you had bought it back in 2014, you would be earning $1.66 in dividends. Now owning those same shares today, you'd be earning looks like over $6. I believe this is, how many payments do we have? So yeah, it would be right around, I guess, $6.10 or 20 cents, something along those lines. So that growth really can put you in a nice place long term. I like to use the story with Warren Buffett that, he bought the Coca-Cola shares that he owns back in the late 80s. And now he gets in dividends on a yearly basis what he paid for that original investment. So this can be a big deal. I've got lots of companies that pay dividends. And even though I do talk lots about options premium and growing that premium, I'm also growing my dividend income that I receive every month. So this is why I really like to look at Schwab. And then usually I'll come down here. Now their debt is a little bit higher than I prefer typically, but they're a gigantic company. So their debt to equity is a little weird too. I don't know exactly what's going on with their equity, but a little bit higher debt. And you can see they've been paying it off. So at one point it was 86, now it's 59. And these colossal, huge companies, I think they're, what are they? I think they're like $200-300 billion company. We can look over here and it'll tell us market cap $300 billion. They a lot of times or have more choices debt wise. They can, do things that smaller companies cannot. Even with health insurance, I know after working for AT&T, where they self-insured, they could do things that other companies could not do health insurance wise. And the same thing with debt. So that's AbbVie. Now, let's take a look at the trade that I did with them. So I did this back a couple weeks ago on 5/20, May 20th. And I did a 155, 145. At the time, they were 164 with a 23 delta. So I took some risk, but not a huge amount of risk. Again, because if I pick them up at 155, that's, pretty near a 4% yearly dividend. And again, with just selling covered calls, I can do really well. But I brought in $275, and the required capital was $1724, which is just 2,000 minus the 275.30, and I had a 66% return. And right now, I believe the price hasn't moved much. And I believe it's fairly profitable, so I might even be able to close it early. So that's the first one I wanted to talk about. The other, which some of you may not agree, but I've been wanting to own UPS a long time, and they've recently come down where they're not so pricey. Let's start over here again in Seeking Alpha, and if we look at 5 years, you can see they're not much higher than they were 5 years ago. They have an earnings per share of 820. Their PE is like 16, very similar to AbbVie. Now they're paying a yield of 4.77. So if I can pick them up a bit cheaper, I believe, if I can get them around 130, then you're definitely talking pretty close to a 5% dividend rate. Again, let's look at earnings. A lot of people will say, oh, I won't invest in them because Amazon is eating their lunch. I don't necessarily agree. And the numbers look pretty good. Now, it looks like second quarter 24, they might struggle a little bit. They did beat earnings recently. But then it looks like they're going to kind of bounce back. Third quarter 24 and fourth quarter 24. It looks like they're going to do quite well. And then even more so in the first quarter of 25. So their year over year earnings looks good. Their profitability also looks good. 32 return on equity, not as quite as high as AbbVie's, and then return on total capital, pretty close to the teens. I prefer to see this in the teens, but 12.73 is as close as you can be to the teens at times. Where they're weak or their margins could be a little bit better, but I do believe they're improving, and then net income per employee is still not as good as some of the others. But overall they're doing fairly well. Let's jump over here into UPS. Switch this to 5 years, so again you can get a better view. So you're not overpaying. Like right now, that seems like a lot of stocks are way overpriced. So here, if we again look at the dividends, and you can see they've increased pretty nicely. 8, 9, 9. What is that? That may be a lower one. That's 7, I believe. And then recently, pretty major increases. So the same thing here. If you owned them back in 2014, you would be earning, and I think if we double this, 2 payments, you'd be earning almost $6.52. So again, the compounding with the dividend growth can be huge. And I've seen that firsthand because a lot of the stocks I've owned for a long time now are generating some really nice dividends. Their dividend coverage ratio is a little bit higher, so they're paying out a bit more, but they do have really good cash flow, a lot of cash flow out there to cover their dividends. That's why they've been able to increase them. And then if we come down and we look at debt here, you can see they've actually beaten earnings all year. And then we look at debt. So they've actually been buying back shares, and they've lowered debt since 2020. They increased it recently, but just like AbbVie, they're a very big company, so they can choose what they want to do and not do. So they're a $118 billion company. So a lot of times they're doing self-insurance. They have a lot more choices debt-wise, so they're probably paying much better rates than smaller companies. So the debt's a little bit less of a concern. It is still a little bit higher than what I'd prefer it to be. I'd prefer it to be more like 12, 10 or 12, or maybe as low as 8 or 9. But again, with all the trucks and all the warehouses and the equipment, they're a typical kind of company that does have a lot of debt. And let's look at their trade. So I did a trade with them on May 23rd. I did a 135, 125. So it's pretty close to the money, and they have come down a little bit more recently. They were nearly 140 at the time. It was a 27 Delta expiring July 19th, so fairly soon here. If they get up to probably 142, 143, it'll become very profitable, and I could potentially close it early. But now I think we're 28, 29 days from July 19th, but I brought in $305.38 for a fairly short number of DTEs. I believe the DTEs, if you look at this percent up here, it's 57. At that time, it was 57 days. The required capital was 1694, which again is just the 2,000 minus this, the 305.38. So again, another really good trade, and a company, like I said before, I'm fine with owning. I want it to be part of my portfolio. Actually, I want both of these companies to be part of my portfolio. Some of the biggest dividend payers are companies I've owned for a long time, like that example I just gave. I also own Procter & Gamble. I've owned Coke for many, many years, and that dividend is increased, but not as much as both UPS and AbbVie increase their dividends. Another one would be Home Depot. I would also like to own more of them. I do own some of them, but I don't currently have 100 shares. But this is what I wanted to show you guys. With my trading, I'm changing it up a little bit more. I more recently did mid caps, companies like Square and Zoom and Path, and Shopify and Twilio. A lot of those are mid caps, so like 15, 20 billion dollars. These are monsters. These are Like I said, AbbVie is a $300 billion company and UPS is around a $120 billion company. So I like to kind of mix these up some and make it a little less risky. And if either one of these get assigned to me, then I'll turn around and start selling covered calls and enjoy the dividends as they come in. So let me know what you think. Do you guys agree? Do you not like these companies? You have others that you might want to suggest. Leave a comment about other companies you think would also be a good fit. That have some of these same criteria. And as always, thank you for joining me, and I look forward to seeing you next time.